Good Monday. This is Jay Brew, co-chairman of Sea Freedom Brew. Well, Denise Ronson, the CFO at Mock Chunk Trust, who is a friend and client, asked the question in terms of what could happen with our cost of funds if the Fed started to raise the target rate. And so we went back in history. And what we looked at was cost of funds running the red line versus the blue line, which was the way that the Fed lifted rates back in 2005 to 2006, once again when rates were at their highest before the financial crisis. So when we looked at this and compared it, there's a number of interesting things. For instance, there was a spread between cost of funds and where the Fed funds rate of 162 basis points. And of course, when we compare it now, it's actually flipped, and the actual cost of funds is 16 basis points more than where the Fed fund rate is at 0.41 cost of funds. So when we look at this and sit there and say, what are the possibilities in terms of what kind of span can we look at if things are done at the Fed based upon how they've done it historically in the past? And these comparisons could be thrown out the window based upon what the Fed does, but I think it gives us a range in terms of how we might plan if interest rates start to move up on an overall short-term basis, which of course we haven't seen for a long period of time. Well, let's look at how much did Fed raise rates back then, is that it was 200 basis points on this upward move. It happened over a period of time of over a year and a half that we had those higher level of rates. But when we think about that and put that into perspective, cost of funds during that time period moved up a total of 187 basis points. So it moved up almost as much, but once again, it didn't reach the high compared to, once again, where Fed funds were versus where cost of funds were. So if we look at that and say, what would happen if we had the exact move of 200 basis points upward in the Fed fund rate, that would put our cost of funds at 2.26%. But in comparison, it's a huge percentage comparison difference where we are now, where we were before when the Fed started lifting rates. So could we look at that on a percentage basis in terms of that kind of rise? And if we did that, we would be looking at 0.85% in terms of a rise in cost of funds. So as I look at it, if I were doing ALCO planning, for instance, in here, and what would we put in our model to sit there and say could be the breadth of our move in cost of funds, is that I would look at it in both scenarios, looking at this as most likely a worst case scenario versus a percentage case scenario. And to sit there and say, looking at those two scenarios, if rates moved up, what impact would this have in terms of a net interest income? What kind of significance would it be if we did get that 2.26% or if we got 0.85%? So it at least gives us a point of comparison, because when we look at the ALCO view from the regulators, with them saying, oh, we'll shock this up 400 basis points, I think that once again, based on history, that a 200 basis point rise or a cost of funds at 2.26% over a 2-year time frame is really the way that I would manage from an overall ALCO standpoint. This is Jay Brew. Have a great week.